online series. On May 12th, we have a professional investor's guide to crypto assets, everything you need to know about a rapidly emerging asset class. On May 25th, we have Capitalizing on Uncertainty, the value advantage in non-US and emerging markets. And on June 16th, we have our annual meeting featuring a conversation with BlackRock's iHub team. We are joined today by Kevin Carter, founder and CIO of Emerging Markets Internet and E-commerce ETF, and chairman of the EMQQ Index Committee. Please submit your questions to Kevin via the Q&A feature within the Zoom controls at the bottom of your screen. And without further delay, I give you Kevin Carter.
Great, and thank you, Aaron, and thank you all for joining today. Now, I'm going to do three things here in my talk today. First, I'm going to tell you a little bit about my background and how I came to be focused on China and emerging markets more broadly 16 years ago. And then I will summarize for you what I think are the main things that investors should keep in mind when investing in emerging markets. And then finally, I will hope to convince you that the approach that we've developed is a superior approach for long-term investors trying to capture the real growth in emerging markets. So with that, I'm located in San Francisco. I'm actually 15 miles east of San Francisco. I've lived here my whole life, except for a few years off in college. And I came back from college and started my career in January 1992. I had one interview with a firm called Robertson Stevens and Company, which some of you may remember, was the West Coast, leading West Coast focused technology investment bank. And my interview was 20 minutes long. For 19 minutes, we discussed college basketball. I then got a 1-minute overview of the investment business, and then I was told that I could start Monday. And I immediately responded, how could I possibly start Monday? I don't know anything. And the person that was interviewing me said, well, go buy this book and read it over the weekend. And he went out, or he wrote down on a piece of paper, A Random Walk Down Wall Street. Now, some of you probably know this book. It was first written in 1973. And in that first edition, the author, Burt Malkiel, suggested that somebody should make an index fund because there were no index funds. And so this book and its author have long been associated with the concept of indexing. Burt is a Princeton economist and a member of the Vanguard Board of Directors. And he was also the chairman of the committee that created the first ETF, the Spider. So that's the book I read to start my career, a book about indexing and efficient markets. But very quickly, I gravitated towards Omaha in terms of the way I think about investing and business. And I try to think about how Charlie Munger and Warren Buffett would look at things in both of those two areas. But having said that, the last 20 years, I've actually worked with this guy. So I've had one foot in the active world and one foot in the indexing world for, I guess, 22 years now. And as part of our work together, we started in 2001 a company called Active Index Advisors, which was a pioneer in what's now called direct indexing. Building customizable separate accounts based on the S&P 500 that would allow for not just customization, but tax loss harvesting. And that company was acquired by Natixis in December of 2004. But a few months before we sold the company, Google went public. And when Google went public, they had an investor planning day for their people. And they had two guest speakers that day. One was Bill Sharp, and the other was my partner, Burt Malkiel. Now, I wasn't involved with that presentation, but I heard about it, and I had dinner with Burton the night before. And a few months later, my phone rang, and it was a guy from Google who had apparently Googled me. And he said, hey, I heard about this active indexing you do. How do I invest? And I said, well, you need to have an advisor at Morgan Stanley or Credit Suisse or Deutsche Bank, because those were the places where we were approved. And he said, well, I don't have an advisor and I don't want one. And he convinced me that I should serve as his sort of default investment advisor. And he then introduced me to a few of his friends that were also very early people at Google. And so all of a sudden, I'm going back and forth to Mountain View every week to meet these young, wealthy people. Meanwhile, my partner Burton is going back and forth to China. He had taken a great interest in China. A couple of his Princeton colleagues were Chinese nationals that had returned to teach economics in Beijing. All of that back and forth of Burton's led to a white paper that he published with these two other gentlemen that was published in the Journal of Investment Consulting and later became a book. And the people at Google heard about this and they called me and said, hey, can Burton come down here and give a talk about China? And I said, sure. Next time he's in San Francisco, I'm sure we'd be happy to do that. And it was 16 years ago last month that I drove down to Mountain View from San Francisco one morning with Burton, and Burton gave a talk about China. And as soon as his talk ended, all these people at Google looked at me and said, we want to invest in China. Now, at that point in my life, I had never been to China, and I really didn't know anything about China other than what I had read in Burton's paper. But somehow from the time that talk ended until today, my entire life professionally has become wrapped around trying to figure out what on earth does that even mean to invest in China, and how should an investor go about doing it. So with that lengthy intro, let me now speed up and tell you what I think you need to know. So first of all, when we talk about emerging markets, the best way to think of this geographically, from a population standpoint, from a market cap standpoint, from a GDP standpoint, it's about 60% an Asia story, with China being by far the biggest part of that. It's about 20% in Central and South America, with Brazil and Mexico being the biggest pieces. And then it's about 10% in Africa and 10% in Eastern Europe. So that's what we're talking about geographically. Fundamentally, we're talking about the world. This is where the vast majority of the world's people are, 85% of the population. Even more of the future, as measured by young people, those under the age of 30, for which emerging markets account for almost 90%. Their economies have been, on average, growing at about twice as fast over the last couple decades. They're now larger than the developed world economies, as the left side of this slide shows. But on the right side, you can see the emerging markets share of a number of different categories, 3 of which have red arrows calling them out. The top red arrow is showing you again that the vast majority of the world's people are in emerging markets. But the bottom 2 red arrows are showing you that in the consumption categories of retail sales and consumer spending, emerging markets are way, way behind. And it's the difference between that top bar and those 2 bottom bars and the closing of that delta. That's the most important thing. The thing that is emerging are the people. There are billions of them, and they're moving on up. And as they move on up, they want stuff. They want more and better food, more and better clothing. They want appliances. They want entertainment, vacations, cars, and they want their kids to go to Harvard. And that's the story. I didn't have to figure this out. It was pretty well documented when I got dragged in 16 years ago. And you can see here at the bottom of this slide that McKinsey Company actually concludes that this isn't just a big deal, but in fact, in their opinion, it's the biggest growth opportunity in the history of capitalism. So maybe they're wrong, and it's the second or third biggest opportunity in the history of capitalism. But for people looking to invest in emerging markets and make money, it's what you should be focused on. So we will come back to that as it is the foundation of everything that we do. So now that's lesson number 1. Now, lesson number 2 is this. There are a lot of serious problems with the indexes for emerging markets, the broad indexes, the single country indexes, the China index in particular. And there are several problems, but I'm going to point out the biggest problem first, and later on I might mention the second problem. So when I got back to San Francisco with Burton that day 16 years ago, we went right up to the office and I walked straight over to our portfolio managers and I said, the Google guys want to invest in China. And sorry, I'm changing my name. I just noticed I have the wrong name on myself. There I am. Okay, so I went back to the office. I asked for the list of all the companies in the China ETF because the Google guys wanted to invest in China, and I assumed we would just use the iShares China Fund with the ticker FXI. And I wanted to see what exactly the companies were that were in the ETF. And before they gave me the list, Burton pulled me aside and he said, look, when you get the list of all the companies in the China ETF, you're going to see that the vast majority of them are Chinese government-owned banks and oil companies. And I said, yeah, I've heard about that. And he said, let me tell you how these companies operate. And he gave me the following example. He said, you've got a Chinese manufacturing plant with 15,000 employees. It's been losing money for a decade, and it's about to run out of money again. The management goes to the state-owned bank in town and says, hey, we need more money. Now, a normal banker would say, no, you can't have any more money because you didn't pay us back the last money and you're losing money and you're basically bankrupt. But the state-owned bank doesn't say that. The state-owned bank says, well, if you run out of money, then all of these people, these 15,000 people, are going to be out in the streets protesting, and we can't have that. And so the bank makes another loan. Now, when Burton gave me that example, it made me literally nauseous inside, because with my simple Omaha brain, earnings equals value, and the growth of earnings is what leads to the growth of value. And if the people that run these companies don't care about that, why would you invest in them at all? In the case of the China ETF, back then, it was 80% in state-owned enterprises and less than 10% in the consumer sector. In the broader emerging markets indexes and the ETFs that track them from people like iShares and Vanguard, you'll find that a full third of the index is still made up of state-owned enterprises. And these companies have serious conflicts of interest. They're very inefficient. Poor corporate governance is putting it very mildly, because corruption is everywhere and you don't have to look very far. It's in the papers every week. The best example of this is the Brazilian oil giant Petrobras, which was being systematically looted of billions of dollars by the elite of the country, including the last two presidents, who both went to jail for basically stealing your money or your client's money if you're using a traditional emerging markets broad ETF. And so this is a real problem. And it's even bigger if we count two other groups of companies that share a lot of the same problems. The former SOEs in Russia, now controlled by the oligarchs, and the chaebol in Korea. If we counted those two groups of companies, it's closer to 50% of the index in these businesses. And these companies have a lot of the same problems, including people going to jail. Here you see a couple of protesters in Korea wearing masks. The mask on the right depicts the former president of the country, who was impeached and sent to jail for accepting bribes from the fellow pictured in the middle, the former chairman of Samsung. Now, he did get out of jail in time to make the Olympics in Korea, but he went back to jail earlier this year for additional financial crimes. So this is why investors that want to make money should not use traditional broad emerging markets ETFs. They need to get a little bit more precise and take a more thematic approach to that growth. Now, this is a concept we call emerging markets 3.0. So in my first 8 years on the China scene, Burton and I launched a number of China ETFs with Guggenheim partners. But when I wasn't working with the Guggenheim people, I was in New York City and Boston with a couple of dozen different family offices and foundations and endowments. And I watched how they were evolving their approach to emerging markets. They were slowly increasing those allocations from a, call it toe in the water, low single digit weight, to a larger weight, up over 10%. But as they got a larger exposure and they saw people going to jail for stealing their money, and they saw that their returns didn't seem to match all of this economic growth, they decide they need to get a little bit more precise. And in one of the best examples of this, David Swenson at Yale took a young Chinese analyst who was an alumni and said, go back and pick some good investments for us, and here's $50 million. And that worked out extremely well for all parties. But most people didn't have the luxury of investing in a group like Hill House. So what I would tell people to do is, look, this is easy. Just buy the consumer sector. Leave out the legacy economy and the materials and the corruption and the oil and the banks, and just buy the consumer, because that ultimately is the story. If you believe McKinsey, it's the place you want to be. And there's an ETF that actually tracks this sector. I didn't create the ETF. I had a number of China ETFs with Guggenheim that now have the Invesco brand. But when people would ask me, what's the best ETF to invest in emerging markets? I said, that's easy. Buy the emerging market consumer ETF. The ticker symbol is ECON. And that ETF owns the 30 largest emerging market consumer companies according to Dow Jones. So that's what I told people to do. Now, it was about 8 years ago, maybe a little less, that I woke up one morning and I looked in the mirror and I thought, what on earth have I done with my career? I was this young, cocky stock picker, and somehow I got mixed up with this Princeton Vanguard guy. And now he's got me building Chinese index funds. And something's clearly gone awry in my path, and I need to go back to my roots. And so I told the Guggenheim people I would continue to support them, but I was going to set up my own investment partnership and do my Warren Buffett meets emerging markets effort. And I did that. And once I had my partnership set up and I had myself invested in it, I invested in 5 stocks. And then after a little while, I thought, well, I should at least go see if any of my friends want to invest in this partnership with me. And so I scheduled some meetings, and the morning of those meetings, I made some slides to show the people what I was up to. One of the slides was a list of the 5 companies that I put the money in. Now, all of these 5 were clearly parts of this emerging market consumer story. The first 3 were actually in the emerging market consumer ETF. Those 3 stocks trading in Hong Kong were Want, which is the Nabisco of China, branded snack foods. The second and third companies, Chinese sportswear companies, Li Ning and Peak Sports. You can think of these as the Reebok and Converse of China. So those were the first 3 companies, traditional consumer names, food, clothing, all of them in econ. But then I had 2 other stocks that were clearly consumer plays, but they were placed into a different box in the database called technology. The first one traded on the New York Stock Exchange was WUBA, W-U-B-A. This is the best thought of as the Craigslist of China. And then the 5th and final company trading on the NASDAQ has the ticker symbol MELI, Mercado Libre. And that was it. Those were the 5 stocks. And I looked at the slide and I thought, all 5 of these are consumer plays. The first 3 that are called consumer stocks, they're great. They're growing at 15 or 20%. I think they have moats in form of brand equity. But then I looked at the other 2 companies, the 2 technology companies. They were growing at 100% and had incredible margins. WuBa had a 94% gross margin, which is where I look for moats, and by far the highest gross margin I've ever seen. And so these were growing 7 times as fast. They were very profitable. And while the PE multiples were higher, the PE multiple divided by the growth rate, the PEG ratio, which is all I care about, the PEG ratios were lower than the consumer stocks, and in fact, quite reasonable. And I just remember thinking the 2 best emerging market consumer companies I own aren't even called emerging market consumer companies. And that was it. I printed my slides. I drove around town. I had my meetings. I got some checks, and I was on my way back home when my telephone rang while I was at a stoplight. I answered the phone, and my friend said to me, "What's the best emerging markets ETF for my 3-year-old daughter's college fund?" I started to tell her to buy econ because that's what I always said when people ask me that question. But then I had a light bulb moment and I said, wait a minute, the best emerging markets ETF for long-term investors doesn't exist. And I immediately went back to my office and started to organize EMQQ that afternoon. It launched 100 days later on November 12, 2014. So now let me tell you how to think about what this is all, what EMQQ is all about. And it wasn't as clear to me then as it is now. I could see the incredible growth rates. I could see the incredible profitability, and I could see that the valuations were quite reasonable, but I didn't quite understand what was driving it, not nearly the way I do now. So let me tell you how to best think about this. What we're talking about here are 3 very, very big mega trends happening in the world at the same time. All 3 of which we take for granted because we've had them from the beginning of their existence. So the 3 mega trends that are part of this story are, first, this one. We've already covered it. Billions of people moving on up and wanting the stuff that we've had for decades. Now, when I got that call that day, I answered it on my iPhone, which was sitting on the car seat next to me. I had a smartphone, but I had only had it for a couple of years back then. And I could already see how it was changing the consumption of my family. Back then, my family used to go to this store 4 times a week, which was very easy to do. It's 3 miles from our house. We have a car, the roads are paved, there's free parking. It almost couldn't be any easier. But all of a sudden, this guy started to show up at my house once a week and then twice a week. Now, before the coronavirus came to town, my family didn't go to this store anymore, except for maybe once a month. And meanwhile, this guy and others like him are at my house 20 times a week, so often that I could tell what color the truck was just from hearing it. So if you think about how this device has changed our consumption and you map it over to these people, well, then the story gets really big. Because while I had a computer for 20 years before I got my iPhone, the reality is most of the world has never had a computer. So the second megatrend in the story is the computer. Now, if you're talking about the one on your desk, they're never going to have a computer. So all of these people are getting their first ever computer. It's in their pocket. And in 90% of the cases, it doesn't have an Apple logo, because we're talking about $60 brand new smartphones running on Android, made in China by Huawei, Vivo, Oppo, Xiaomi. They're getting better and more affordable every year. And they're bringing with it the third mega trend, which is something we also take for granted, something that I've had for 25 years here in San Francisco, starting in the Marina District over a telephone line. The third mega trend is the internet. So as I said, in 1995, I got my first internet access, and then it went from the telephone line to the cable. Then they gave me Wi-Fi. Well, now the internet shows up in my pocket wherever I am. Well, the reality is most of the world never got wired the way we are. And so as all of these billions of people are getting their first computer, they're also getting their first internet access. And you can see it's still pretty early. This chart is showing you smartphone penetration by country, the gold bars, the emerging markets. And if you look towards the right, you can see India is only about a third penetrated with smartphones, which means that you have over 900 million people that don't have a computer or the internet. But that's changing very fast, very, very fast. But if you add up the non-smartphone population, there's still a couple of billion people yet to be online. So now you take those 3 megatrends, billions of new consumers, computers in form of $60 smartphones, internet access for the first time, and importantly, because these markets don't have the consumption infrastructure in emerging markets is by definition underdeveloped. And when I say consumption infrastructure, I'm talking about the following types of things: bank accounts with debit cards in everybody's pocket, cable television on the wall that has 1,000 channels, and Target stores. Because those things don't exist, these people are leapfrogging what we think of as traditional consumption and are even more digital than we are. The result of this is this slide. This is the money slide, literally and figuratively. This is showing you a story of massive growth. For the decade, actually, we just updated the slide, so this is the first time we have the 11-year slide up. For the decade, these companies grew for the 11-year period, actually, they grew their revenue at almost 40% a year on average. So that's not easy to do. And when I first gave this talk to the CFA Society of San Francisco in 2014, just after we launched, you can see what the revenue looked like then. And I offered the audience a ham sandwich. If anybody could show me a sector that had grown that fast for 5 years, after giving this presentation to a couple dozen more CFA societies, I raised my reward to $10,000. And finally, after not having anybody find a sector by the way, my challenge I forgot to mention is if you can find me a sector that's ever grown this fast, I would give someone first a set of ham sandwich, then I raised that to $10,000. Now I offer $100,000. So if you can find me a sector of companies that's ever grown this fast over a decade, I will offer you $100,000. Now, once we went from 10,000 to 100,000 in our reward, there are a few rules around that. But the reality is I could be wrong. It's possible there's another sector that's grown this fast for a decade, but I've asked everybody I know who's smarter and more experienced than me. And so far my inbox is empty. So this is, I believe, not only the fastest growing sector in the world today, but the fastest growing sector ever in terms of revenue for public companies. So what comes with that fundamental growth? Value creation. So you can see in blue how the emerging markets internet space has done over the last 12 years. Meanwhile, bouncing along the bottom in yellow, you can see how the traditional broad emerging markets approaches have done. And really, they haven't done much of anything. Now, let me make a few important points on this. So you can see that there's a 65.5% return achieved by the broad index over that 12 years. The reality is that all of that 65% came in the last year. So before that, you had 11 years where emerging markets did nothing. And if we took this chart back 2 more years and made it a 14-year chart, you just got back to break even. You made nothing in 14 years. So not just a lost decade, but almost a lost decade and a half. And I have to tell you that it's my strong opinion that emerging markets are, as a category, the biggest value trap in the world, because I see this time and time again. Some chief investment officer will put out a report or go on TV and say, we are very bullish on emerging markets. And then they'll say the following 2 things. The PE is so cheap. It's half the PE of the S&P 500. The emerging markets have a PE of 12 or 14. The S&P 500 is double that. So it's half the price, and the economies are growing twice as fast. So I'm getting twice the growth economically, and I'm paying half the PE multiple. How can that not be a bargain? That is a trick. If you knew what the agricultural bank of China was, you probably wouldn't want to own it for 3 times earnings. So I am not optimistic when people say that emerging markets are going to come back in favor. I think the structural problems I described will never really let it fulfill the promise of emerging. So buyer beware. Now, there is a broad emerging markets ETF from Wisdom Tree with the ticker XSOE, which attempts to leave out the state-owned enterprises. And if you absolutely need a broad approach, then I suggest you look at that. So fundamental growth, value creation. Now, let's talk about some of these companies. So Alibaba is our poster child. My backdrop is Alibaba's headquarters in Hangzhou. And so this story is really not a secret. I mean, the largest IPO in US history was a Chinese internet company of all things. And let me point something out. Most of these companies have historically gone public in the United States. And the reason is this: these companies are always founded by local entrepreneurs, but in the vast majority of them, they're getting funded by US institutional investors. That could be Harvard or Stanford's endowment through a fund, or in these 2 examples, corporate investors. You had Jerry Yang and Yahoo lead a $1 billion investment into Alibaba, which grew to be worth $50 billion, 10 times what Yahoo just sold their business for again, or got sold for again. And then in my favorite story from the last couple years, Berkshire Hathaway bought 5% of this Brazilian fintech company in its IPO on the NASDAQ, Stone. I believe the first IPO ever for the Berkshire people. So my point of this slide is this: corporate governance is your biggest problem in emerging markets because of the capital formation processes these companies have gone through. A, they list on our exchanges because we have the highest listing standards, but B, they have very good corporate governance on an absolute basis, and on a relative basis to things like Petrobras, you'd have to say they have exceptional corporate governance. Now, let me take the time then to point out the other flaw in traditional indexing. So the best thing that happened with the Alibaba Group IPO is that something I complained about for 10 years finally got addressed. And so I mentioned earlier how I got started 16 years ago at Google and drove back to my office and said, hey, I need to see what's in the China ETF for these Google people. And after Burton gave me his warning and I got the list of all the companies in the iShares China ETF, I went through the list company by company. And then I got to the bottom and I said, how come Baidu isn't in the China ETF? We called the iShares people and they said, well, we don't consider it a Chinese company. And I said, what do you mean you don't consider it a Chinese company? I said, it's the Google of China, and the Google of anything seems like a good thing to be. And the Google of the largest country of the world seems like a really good thing to be. And they said, well, we don't include Baidu because it trades in the United States. And I said, that's the stupidest thing I've ever heard. And so for 10 years, I complained about this problem. And finally, when Alibaba came public, it made the newspaper that Alibaba was not going to be in your index fund. Vanguard and iShares would not own Alibaba. They would own all of the Chinese state-owned policy banks. They would own Brazil, Petrobras, 2 times, the preferred and the preferred and the ADR, but they wouldn't own Alibaba. Now, the USA Today and the Consumer Reports both wrote articles about this. I was overjoyed. It still took them 3 years before Vanguard and iShares added Alibaba. So while to add insult to injury in this yellow line, which is laden with all the legacy state-owned stuff, the entrepreneurial internet companies in the blue line weren't included in the yellow line. They finally kind of fixed it, but not really. A lot of these companies are still not to be found in your broad emerging markets ETF, including this Brazilian fintech company, Stone, trading on the NASDAQ. Now, you will find Tencent. And in fact, to the extent that that long, broad index fund has performed at all, there's no bigger contributor to that than Tencent, which has been included in the indexes because it trades in Hong Kong. So most of you probably know Tencent by now. When we launched 7 years ago, only about 20% of the advisors we talked to knew what Tencent was. And so to make it easy, we would tell people it's the Facebook of China. And it's true. WeChat, Tencent's platform, is the social network for China. It has over 1 billion people on it. It's how I communicate with my friends and colleagues, as I did this morning on WeChat. So it's fair to call Tencent the Facebook of China. However, you can't call Facebook the Tencent of anything. And this is an important point. In the case of Alibaba and Tencent specifically, but also with a lot of the other companies in this group, they don't have a US equivalent. And the reason is, as I mentioned earlier, the consumption infrastructure in emerging markets is not developed by definition. And that includes bank accounts with debit cards, televisions on the wall, and Target stores. Because those things have never been developed, it's letting Alibaba and Tencent go into all consumer verticals and compete in a digitized fashion. Let's look at a few. Healthcare. Alibaba's healthcare business is a separate publicly traded company now that we picked up in our index last year. Tencent is getting ready to IPO their healthcare business. JD.com, one of our other top holdings, IPO'd their healthcare business in Hong Kong last December. So these are healthcare companies. They're entertainment companies. What's the Spotify of China? Tencent Music and Entertainment, TME, on the New York Stock Exchange, separate publicly traded company. Alibaba's won Academy Awards for some of their work. Groceries, food. This is the most amazing thing I've ever seen in China. I will not be able to do it justice with a few words, but this is Alibaba's grocery store, Hema. And if you look at the lower half of the slide, you'll notice it looks a lot like a Whole Foods, but up above on the ceiling and on the walls, the elevators and conveyor belts that automate this operation is out of the Jetsons. I literally can't put words on what you will see in one of these markets. I could, but it would take up the rest of the webinar. So I'm going to move along. But these companies are in grocery. So these are not technology companies. These are all things consumption companies that are operating in a smartphone world. And by far, the biggest of these consumption verticals is financial services. FinTech is blowing up in the developing world. We're getting left way behind on this. So let me talk about how this is playing out. So all over the developing world, we're seeing the traditional banking get leapfrogged, and it all starts with payments. So you'll see here, this is a picture I took in China, my favorite city, Nanjing, a couple years ago. And in any Chinese city in the mornings, you'll see people come in from the countryside with their eggs or produce, and they set up in the alleys and sell what they've got. If you look in the red circle at the bottom of the slide, you'll see two QR codes, one wrapped in green, one wrapped in blue. The green one is Tencent's payments platform. The blue one is Alibaba's payments platform. Every place in China that you want to spend money, you're going to find both of those two QR codes. And if you stood on the corner and watched this business all day long, you wouldn't see one person get out their wallet and pay cash. Ironically, the same day that I took this photo, we were in the subway station down below the street here trying to get across town. And I went to the newsstand and I grabbed a bottle of water and I put it on the counter and I took out a Chinese banknote and I tried to hand it to the man behind the counter. And he told me like that no, I was not going to have a bottle of water. Meanwhile, up on the street, I could buy anything with a QR code. So this is a huge deal. And you can see on the right side of this slide, Alibaba and Tencent now have the money. And once you get the money, and it all starts with payments, then you're in and you can get into pretty much every financial service. Wealth management. Alibaba has a wealth management platform that they launched in China with Vanguard as their partner that now has 100 million users. You can get into insurance. Alibaba and Tencent actually co-founded an insurance company that's now publicly traded in Hong Kong and part of EMQQ. And finally, and importantly, you can also get into banking and credit. And this is where things went awry, if you will, in China back in November. So let me just touch on, I'm going to touch on what happened with the Ant Group failure, what I think it means to the Chinese fintech story. And then I'll also bundle together some of the just negative stuff swirling around China as it always does. So the Ant Group IPO was going to be the largest IPO ever. It was going to trade half in Hong Kong and half in Shanghai. They were going to raise about $40 billion, which would make it $10 billion than Saudi Aramco, and the largest ever IPO, and on a $300+ billion market cap. And the deal was pulled on the at the last minute by the Chinese government. So on November 3rd, the Ant Group IPO didn't happen. And let me just review a few things here. First of all, Ant Group was absolutely booming. It was a monster of a business. It had massive revenue, it had massive growth, and it had massive profits. So it had a 30% net margin, 40% growth. And most of the profits were coming not from wealth management, not from payments, not from insurance, but from lending. So they had set up a lending platform, two programs actually. They were originating consumer credit on a major scale. 500 million people in China had formed some credit on the Ant Group platform in the year leading up to the filing. And they were not being regulated like a bank, and they didn't want to be, which I wouldn't want to be either if I had a 30% net margin. But the reality was they were taking their loans and they were originating them, and they had great credit scoring data to do that, but they weren't keeping the loans. They were pushing the loans out onto the banks. And I think when it went down, I thought that I saw sort of a perfect balance between the entrepreneurs and the regulators. But the more I've looked at this and thought about it, I think the regulators had to slow this thing down because it was very quickly becoming the Chinese credit market. And so they halted the deal. Alibaba's stock has been under a ton of pressure. But I think the Chinese really handled this very well. They, in a period of about 5 months, went from this event, which really spooked investors, and they reworked the regulations and got all of the other fintech companies to comply. And there's no doubt it has been a significant decline in the value of these businesses of 30 to perhaps 50%. Fidelity marked their holdings down 50%. I think it's more like 30. But either way, this opportunity remains huge. I have no doubt Ant Group's going to be $1 trillion company at some point. It's just going to take a little bit longer. Now, you also had the Chinese antitrust issues that showed up the next week. I think those have also been handled. So back about a month ago, both of these issues were addressed, and Alibaba did pay a fine. And now they're sort of slowly moving through some of the other larger Chinese companies and making sure that they're following antitrust and monopoly issues. And this is not unique to China. I mean, you've got Apple up in front of a judge now for these types of things. So this is not a China only thing. And between the Ant Group fail and the monopoly antitrust issues, been a lot of negative stuff over China, not throw in the delisting threat. Either way, this is all noise in the story. The Chinese government is not set on shutting down Alibaba or making it an example of Jack Ma. Jack Ma was not missing. These are the types of negative boogeyman things that get proliferated here in the United States. I've given up on fighting it. I think the vast majority of people hold some of these things to be true, whether it's the accounting or the evil government or the treatment of the Uyghur population. All of this stuff is not, in my opinion, nearly as bad or even bad at all. So let's move on from China. Now, I talked about Mercado Libre at the beginning of this, one of the companies that inspired EMQQ. This has been one of our best performers the last few years, largely because of the fintech story. Their fintech business has been on fire. It's the reason we've been really pounding how big this story is. The Ant Group IPO would have been a big pure play on this, but it's happening in a big way in Mercado Libre, which technically is an Argentinian company. So the fact sheets will say Argentina, but the revenues are coming from Brazil and Mexico as the two largest markets. And let me point something out. You're not going to find this company in your Vanguard or iShares fund. You're going to find the corrupt oil company Petrobras, but you're not going to own the Amazon.com and PayPal of Brazil. Eastern Europe, this is another company that you won't find in the broad emerging markets approaches. This is the Google of Russia, trading on the NASDAQ, Yandex. It's also become the Uber of Russia. It launched the Yandex Taxi and competed with Uber and won. So Uber left Russia, but not before taking a minority stake in the Yandex Taxi, which will probably IPO sometime soon. Now, India is full of hope, but right now it's not full of market cap, at least in terms of emerging markets internet companies that are publicly traded. This is one we do own, Make My Trip, sort of an Expedia of India. There's a lot coming down the pipeline in India. I'll mention a couple of those a little bit later. And finally, Africa. This is the Nigerian e-commerce leader, Jumia, that trades on the New York Stock Exchange. It operates in a number of other countries besides Nigeria, also getting into the fintech part of the story. So this is another great example of how this story that we've lived now for a decade, the smartphone story, is spreading all over the world. And this is also the most volatile stock I've ever owned. So let me tell you about some recent IPOs and then tell you some of the more exciting names that are coming down the pipe that most of you will hear about when they come public, and maybe you'll hear about them here first. So some recent IPOs that we've had. This is a TikTok type app that Tencent funded called Kuaishou, which went public in the first half of the year. This is a fascinating e-commerce company. This is Coupang, perhaps the most efficient of all e-commerce companies in the world in terms of, in particularly packaging, where they're way out on the cutting edge in terms of reducing packaging and reusable packaging and even deliveries with no packaging. Dominates in Korea, recent IPO on the New York Stock Exchange. Eastern Europe had a couple big ones in the second half of last year. The leading e-commerce company in Russia, which has a very low e-commerce penetration rate right now, Ozone on the NASDAQ. And finally, in Poland, the Amazon.com of Poland, trading in Warsaw now, Allegro. And now let me tell you about the pipeline, because there's some big names coming out. So this is Didi, and Didi is the Uber of China, and it registered recently for $100 billion valuation for an IPO sometime in the next few months. Now, this is a company we've talked about for a long time, and this is one that if you're an advisor, you very well may get a call from a client when this company comes public. So here's what Didi is all about. So when ride-hailing showed up in the US about 7 years ago or 8 years ago, people copied it all over the world. Yandex copied it and turned pretty good business out of it. In China, there was two early leaders, Didi Dash-A and Quadai Dash-A, one backed by Alibaba, the other one backed by Tencent. Both of them were booming. Both had about half the market. And then Uber announced they were going to go to China. And before they got there, Alibaba and Tencent merged their app to form a single company now called just Didi, which was essentially a monopoly. And Uber showed up and got beaten very, very badly. And they left China, but did take a minority stake in Didi. And so Didi is partially owned by both Alibaba and Tencent. It's also partially owned by Apple, who made a $1 billion investment after a 1-hour meeting with this woman, Jean Liu. Now, the reason you may get a call about this is this company will come public. It'll be a big deal. This woman, Jean Liu, will be on CNBC and or Bloomberg or other media. And when she's on TV, on the side of the screen, it's going to say Jean Liu, president of Didi, the Uber of China. And that will look cool. But when she starts to talk, not only is she incredibly articulate and charismatic, but the story is a lot more powerful in ways that I don't think we totally appreciate. And here's what I tell people. I've been a power user of Uber from the time I first heard of Uber. And I use it all the time. I use it every month. Even during the lockdown, I use it. And but I only use it in two different situations. If I go to New York City and I don't want to wait in the taxi line, I'll take an Uber into town. Or if somebody invites me over for dinner on a Saturday night and I have an extra glass of wine, I might leave my car and Uber home. Well, what Jean Liu's going to explain is that in emerging markets, people use ride hailing because they've never owned a car. They've never known anybody that's owned a car. And so some of these types of apps that have a convenience factor for us have significantly higher utility in the developing world where the consumption infrastructure is, again, undeveloped. So watch for the Didi IPO. It will be a big deal. This is the Indian leader in e-commerce, Flipkart, which should come public sometime, I think, in the fourth quarter. This company is owned by Walmart, who swept in and bought the whole company 3 years ago. But as I suspected, it looks like they're finally going to IPO it. The Indian leader in e-commerce, this will get a ton of coverage as well. This one probably won't come until 2021, or rather 2022. But this is the company I think has the best chance of becoming the super app of India. I won't go into it in much detail, but this is Geodigital, which is a division of Reliance Industries, India's largest company, a conglomerate controlled by the Mambani family, and a 50-year-old conglomerate with major interests in oil and in textiles, but more recently, a pretty significant retail portfolio, and finally, a Geodigital division, which is now the largest carrier. They launched the first 4G network in India and now have over 400 million subscribers. And they are about to go on a real surge in terms of growing their business. You can see on the right side, they raised $20 billion last year from investors, including Facebook and Google, all for this digital division, which for a number of reasons, I feel strongly this Geodigital will emerge as one of the most formidable super apps in the world in the coming couple of decades. So watch for a Geodigital IPO out of Reliance Industries. And then also in India, this is the fintech leader, Paytm, which has a very large private market cap. It probably won't come public till next year, but you will also hear about this company. And I feature it because Alibaba is the largest shareholder, and my heroes in Omaha are also an investor in this company. Brazil's got a monster online bank, the biggest online bank in the world, Nubank, going to come public this year. And finally, this Southeast Asian, Singapore-based mini super app, we'll call it Grab, backed by SoftBank, is getting ready to begin trading in a merger with a SPAC. So those are some of the things to keep an eye on. So in summary, what I've told you is a story of growth. I believe unprecedented growth explained by these three mega trends happening at the same time. A lack of traditional consumption infrastructure and a leapfrogging, perhaps explaining some of the incredible growth rate. Important side benefit in a part of the world where corporate governance is your biggest problem and you haven't made any money, you actually get pretty good corporate governance. And finally, you get exposure to a lot of the private companies that Alibaba and Tencent have invested in, like Didi and Paytm. And you also get a lot of exposure to the frontier in companies like Jumia. So the pandemic has been a real mess for the developing world. Social distancing, not really possible in the dense slums. And so the suffering is real and big. This will push about 150 million people down the economic ladder, with India being the largest part of that. China's got this thing under control and has had it under control for a year, largely with smartphone-based contact tracing apps. Their economy grew last year and is going to grow, it looks like, in excess of 8% this year. And the government didn't have to make a huge commitment to stimulus to move through it. So China comes out with some gained ground versus the rest of the world. And finally, and uncomfortable for me for the last year, is the fact that the reality is that this coronavirus has really just accelerated the digitalization and forced the adoption of a lot of these types of businesses. So finally, let's just talk about valuation. So we've had, the long-term performance of this group's been quite good. And I am confident the long-term performance will continue to be quite good relative to the alternatives. I don't make short-term stock market predictions, but I'll tell you that last year we had a very good year and we're the top performer, as we were the year before. This year, we started out, or continued some strong momentum in the first 2 months of the year, and we were up 25% coming into March, and then we hit an air pocket, and we've now given back all of those gains from the first couple of months. But the net result for the year, I think we were down 3%, but it's been a little bit of a wild ride, and we've definitely had a slowdown in volume and a decline in the NAV. But I don't make short-term predictions, as I said. All I care about is the PEG ratio. Tell me the PE and tell me the G, and I'll tell you what I think. And right now, the PE for this group is about 40. I think this 43 is a little bit overstated. And the growth rate for this year is going to be about 36%. So I put a 40 over a 36 or a 43 over a 36, and I get a 1.2, maybe a little less than that. And the US tech stocks have about the same PE, but half the growth rate. So their PEG's a bit higher. And then the S&P 500 on a normalized growth basis might have a PEG ratio of 4, 5% sort of the normalized growth rate for the S&P. And you can see it's going to have a little pop this year. But either way, with those relative multiples and with the risk-free rate at 0, I think investors that have a 3 or 5 year outlook will do fine in this group, and I believe quite well relative to the alternatives. And if you have an even longer time horizon, even better, because the next decade looks very good for this story demographically. So that concludes my presentation, Aaron, and I'm happy to take any questions that people have.
Thank you, Kevin. First question is, which other countries show the most promise besides China?
Well, India. India has that has the most people besides China, and it's going to have more people than China, not too far out on the calendar. And it's got a very low penetration rate. It's got a very disorganized traditional retailing system. So there's tons and tons of opportunity in India. And this isn't a secret. This is where the venture guys are and the corporate guys are. But one of the things unique to India is they're very, very protective. And if China was as protective as India, we'd have a whole other set of problems. But they've basically said that they want the local competitors to win. And Amazon is in a lawsuit, a significant lawsuit having to do with a retailer they were going to acquire that they were in contract to acquire, and the retailer decided that they wanted to get merged with Reliance Jio, as I mentioned, and it looks like the Indian courts are going to let them walk away from a signed deal. So yeah, India's got the most opportunity. It's really everywhere, though. South America has half the penetration of e-commerce penetration of Asia. So there's, on a percentage basis, that economy is further behind in adoption of all things digital. Africa, with its 1.2 billion people, has a lot of opportunity, but a lot of challenges in the infrastructure, and of course the kind of chronic political instability there. So all over the world there's opportunity, but India stands out as being the largest, if for no other reason than the largest number of people that are going to get their first ever computer and internet access.
What are you doing in terms of governance analysis, for example, shareholder rights?
Well, this is a rules-based index. So this is an index that I won't use the word passive, but we don't express any issues in that regard in our index methodology. But I would just say that in general, again, everything in the world is relative. These companies are very well governed, and I think that and they have a lot of institutional investors that have been in from the beginning, and so these types of things are certainly looked at by others who are structurally more in a position to look after those things.
What's your policy regarding adding IPOs to your fund?
Sure. So this is a very interesting area. And, one thing I would say in general about indexing and indexing people and ETF people is, there might be some on the phone. You might have some, I forgot there's some ETF and indexing operations in your part of the world. There's a lot of questions about a lot of things in the indexing world that I don't think a lot of people have asked before. And one of them is, how do we get IPOs included in this, and what's the best way to do it? And there's some gray area as well in this question, but our policy is this, and this was a change we made to the methodology last fall. IPOs that are over $10 billion in market cap are added after 3 trading days. IPOs that are less than that get picked up in June and December with the normal rebalance.
Do you see anything happening in Vietnam that gets your attention?
Well, there's a lot of people, and it's a frontier market, and but I think that in terms of who are the winners, who's which companies are competing there, it's companies like Grab, which I mentioned. Southeast Asia's got basically 4 kind of mini super apps that are all in the kind of $20 to $50 billion market cap range. One is Grab in Singapore, which is going to merge with the SPAC from Altimeter. The other one is C Limited, SEA, which trades with the ticker SE here in the US. And that's been, I think, the second best performing stock in the world after Tesla over the last, multi-year period. And then there's 2 more private ones in Indonesia, Gojek and Tokopedia. And all 4 of those our companies are competing in Indonesia, in the Philippines, in Vietnam. And so we haven't seen any Vietnam registered companies come public, but there's certainly revenue coming from Vietnam. But I think, again, in terms of population, Indonesia has the biggest pool of people down there in Southeast Asia. So that's the area that I think we're more likely to see IPOs come from, as we're seeing, it looks like soon, perhaps with Gojek and Tokopedia.
All right, and it looks like we're at time, so I'll have one final question. How do you see the lack of vaccines in emerging markets impacting relative performance?
Well, I don't know how that affects the relative performance in the short term. I think that these economies are struggling. I mean, these are not places that were, thriving by our standards to start with. They're certainly moving on up, but the digitization wave will continue for certain. And again, in many ways be accelerated by this, but there's definitely going to be those billions of consumers. A large number of them are going to have a step backwards in terms of what they can afford to consume. So that will play out. I don't know how that'll affect the performance. Perhaps that's already factored into the performance.
All right. Thank you, Kevin. I appreciate you taking the time to discuss this with us. And thank you to everyone who connected with us today. Please be on the lookout for an event survey to follow, including the audio and meeting presentation. I hope you all have a great rest of your day.
Thank you.
Thank you.